All right, so I'm going to use the symbol field here under the fundamentals to just isolate target. We're going to look at all expirations. We're going to go one strike in the money. So it might still be that 160, but I'm hoping I get the 165 in that case. And I want to sort by not earnings per share growth, but expiration. Expiration date. And I'm going to go lowest to highest, I believe. 160, 160, perfect. This is exactly what I wanted. Okay. Satish's question, he says, thanks a lot for an explanation on IV. I had one more question, if there's time. Hey, it's only 5:34. We usually stay until 6, Satish. It's always there. In your married put strategy, you normally show examples where you buy the put 5 to 6 months out. Exactly. It's following the rules in the blueprint. So we take advantage of the 3 core principles. The at-the-money bell curve is the number one, proper forcing an ideal size trade or proper position sizing in that case. And then the last one, of course, is the at-the-money bell curve. Now, so I'm going, only puts I would look at are March, April, January 2022, and January 2023 with the risks of 8.2 and so forth. Now, as you said, buying longer options gives us better time, but lower cost per day, a lower time decay rate. That being the case, does it make sense to buy puts longer term, for example, 1 or 2 year out? How can we evaluate the pros and cons of these approaches using the PowerOptions tools? Well, I already showed you 2 of them. Number one is this. I can see my annualized, I could look up my risk factor here, but you see here that the risk for the April is 8.7 at 196 days, only 0.5% higher for an additional 30 days from March. I'm going to be honest with you. I'm probably leaning towards the April. I don't mind taking an extra 0.5% risk for an extra 30 days, especially if the call premiums average around 1% for 30 days. That's a win-win situation for me. It's an extra 0.5% potential premium and profit, even though I'm adding 0.5% risk. Going out 476 days, more than double. Does it double the risk? Absolutely not. That's what we were talking about here. It only goes up by 4.3% for an additional 280 days of time. That's possible. And Satish, it's talked about in the blueprint. There's nothing wrong with doing it. It comes down to what is your risk threshold and your expectation for how long you want to hold the stock. Absolutely, I could go 1 or 840 days out for a 17% risk on target. If I'm planning on staying in that position long term, there is nothing wrong with doing it. What is the one subtle thing that changes, though? We're looking at the 160 strike. It's just a little bit out of the money. In the money. My apologies. I'm thinking about calls in my brain because we're going to show selling a call like we did for the original TQQQ position, Satish. But we're going to have to take that into account. What do I mean? Let's say I took my April one. Risk of 8.7%. I'm just a little bit out of the money. So selling the 160 call right now might not be a bad idea if I don't think the stock's going to move. So let's go to our profit and loss chart. We'll stand away from earnings and we'll just go to 14 days out in time. Hopefully Target doesn't have earnings then. And look at that, almost $3 in premium. Maybe it does have earnings coming up. That seems a bit rich. But in any case, here's the April put with a risk of 1478 or 8.5% into this position. We bought the stock at $159.10, $15,910. And we're buying the April 160 put for 1568. Oh, I'm sorry. Yeah, it's going to be inflated, of course, because of the election. But just right at the money, this is an 8.5% risk or 1478. I'm not quite getting a fourth of that by selling this October 16th call, but we're going to get $3 off it, about a fifth of the risk. Now, this isn't bad. Even if Target stays around 160, if it doesn't go above 164 or 155, I'm not giving too much back. Okay, I've got an upper lower break even to start taking the upside risk, reduce my risk to 7%, could still make 1.2% if the stock stays at the same price. Why am I going through this? This is the same discussion with a diagonal calendar spread. If you buy further out in time, we'll go as far out as the 2 years you mentioned. Almost, oh, I'm sorry, my apologies. The 3 years that we mentioned almost to January 2023. Now, even though I'm still buying that same 160, I'm paying $31.50 for it. I am paying double, in this case, what I pay for the April, But instead of 168 days, I've got 840 days out in time, or 190 days, excuse me. I got 140 days out in time, 840 days out in time. I'm doubling the time. I'm sorry, I'm doubling the cost, but I'm more than tripling the time effectively. Now let's sell the October 16th, 160 call at $3. Why wouldn't I do this in this case? Because it's capping it too much. It's only a 0.3% yield. Still have a reasonable upper, not really a reasonable upper and lower break even in this case, but again, it's only 2 points up and 1 point down to hit the upper and lower break even for a 0.3% max profit, and that's if the stock's trading right at 160. It becomes harder now to see a better profit and loss chart that might appeal to you with doing the other income methods, Satish, because you paid so much extra for that further output. That's the subtle difference. What is the advantage of just going further out in time? Well, we're 840 days out in time, almost as you mentioned, that 3-year range, as opposed to 6 months out that we saw with the April series, 7 months out that we saw with the April series. The risk increases, but it doesn't double, right? I mean, it's close to double, but for what? For 4 or 5 times the amount of time. It's not linear, but I did double my risk. That's a con. Harder to do adjustments near term because the risk reward profile is going to be skewed due to the higher cost. Okay. And they're not bad income methods, because you're right. If I sell every 16 days, how many right cycles does that give me for 840 days? No, you're absolutely right. Someone made that comment. I can sell more now, and I did pay less. So although it doubled my risk 4 times the amount of time, 5 times the amount of time, that's a win. Don't get me wrong. But it's harder to do the income methods now. But now you say, oh, but if I sell every 16 days against it, I'll eventually pay for this. Yeah, but that's assuming that the stock doesn't go up too much, or the stock doesn't drop down too much. And even in that case, you're okay because you get the decay in your favor. But that's the risk, is because you paid more into the position, you get that steeper profit and loss chart as opposed to something that's wider if you use the shorter term. Also now, your deltas are about the same. But let's take our far out one. Let's say we get what we want. What is getting what I want? A 3 to 8%. Let's call it a 5% increase in the stock price, Satish. So 16%, dies 0.05. Let's say we go up 8 points. So we're going to be trading at 167. Let's call it 170. Let's say we get a good move, 8%, 7% move. We go up to 170 in the first 30 days. Oops. Okay, and we got to scroll way back here. So we're talking November 2nd, November 3rd, right before the election. Okay, so why am I showing this? Well, we have about almost an $11 gain on the stock, and we're going to lose about $730 on the put, so we're still going to have a gain of $354. This is the 2-year output. The expectation with this implied volatility is that we'd lose $736, and we'd have a total profit of $354. Okay, and now let's go back to April. 196 days out, our 6 months out, half the cost, $1585, right? Oh, I didn't add. I'm sorry, guys. There we go. Okay, now what happens in this case if I'm right? Only risk at 8.5%, remember, but what happens if I'm right in this case and the stock goes up to 170 again by November 2nd? $170, not 17, 170. That's going to look a little bit better, right? Okay, so in this case, wow, that's more than I thought. In this case, we're going to lose $629. So the total profit is $460. Okay, closer to half and closer to what I'd expect. Remember that the 3-year out one, 736. Wow, that's terrible. I'm sorry, folks. My hand got caught there. I was writing with the mouth. And the gain would have only been $354. Because of the lower cost, right? If the stock moves up as you're expecting, if you're only expecting to see gains and you're looking to manage or close the position within the first 60 to 90 days, if you get the gain you want in those first 60 to 90 days, the shorter term put option would have a higher profit than the longer term. But Satish, if you're planning on staying in it for a year or a year and a half, then yes, there's nothing wrong with buying further out. We're saying the minimum is 5 months out. My average is 8 months out. I think it's around 220 days is the average put that I've purchased since I've been trading radioactive positions since 2008, 2009. I think that's my average, around 8 months, 210 days, 220 days, somewhere in that time frame. I've done leaps before. I've gone a year and a half out in time on positions like Johnson & Johnson that I was going to use as a core holding and hold for an extended period. Kraft Heinz, I mentioned a few times. I do that with the longer term. But if I find something that I want to protect, but I think is a good near-term growth stock, my target 3 to 6% in the first 20 to 40 days, or 8 to 10% in the next 60 to 70 days, I want to keep it the risk I want, but I want to keep it shorter term because it's not a core holding. Okay, you get more profit with a shorter term if it moves as you want in the shorter term, as opposed to the far out option. That's naturally just due to the cost. One advantage the farther out option gives you is if the stock does start to move up as you expect or stagnates over the first 30 to 60 days, you can move that put in and you won't see a lot of time decay, where my option that was out to April will probably have started seeing a buck or two of time decay. Well, maybe a buck 50 of time decay. You might have only seen 45 to 60 cents of time decay on that far 840 day out option. So that's a definite advantage. And you can also use that to manipulate with some of the different income methods, meaning income method number 3 and beyond. Okay, so that's my discussion there on long-term puts versus short-term puts. You can see the risk here, and you're right. You know, you can. This is one way to compare the risk, then use the profit and loss chart as I just showed you, Satish, to kind of gauge what would your decay be, or your gain, or gain on the total position if the stock moved up 5 or 7% in the next 30 to 60 days on the shorter term one or the longer term one. And that might help you gauge which one you feel is better for your personal goals. William's question, my apologies. Can you explain the parameter in the market sentiment tool, percent of new stocks, 52-week high and low, and the cutoff value that makes the parameter bullish or bearish? Absolutely. So this is a ratio of stocks that are hitting the highs versus low. It's not just new stocks, something that's just hit a new 52-week high. It's a ratio of stocks hitting their 52-week high compared to those that are hitting their 52-week low. So the ratio is a difference. Okay, if it's a -1, -2, -3, right now we're at 3.3%. So roughly that means there's 3.3% more stocks hitting their 52-week high today than hitting their 52-week low. And again, so the break, I can't skew this one. That's coming next. I can't skew the distribution with the sliders. We can on some of the other charts in that case. But so what we're looking at here is that when this value, we're about at normal. I'd say this is normal range in here. So anywhere from probably about, let's call it 7% to about 6%. But what it's saying is that when this range gets down to a negative value, gets up to a high value, 8, what does that mean? That means 8 times more stocks roughly are hitting their 52-week high as opposed to hitting their 52-week low, which means what? We must have been on a severe run, because what happens? It doesn't, so infrequently over the course of time does this stay above 10. Once it hits that, it usually starts to retrace back to a low ratio, which means what? Less stocks are hitting their 52-week high, and more stocks might be hitting their 52-week low. Or the 52-week low is staying, but less stocks are now at their 52-week high and they're pulling back from it. It's going back to the mean. Okay, so when we have a ratio of 52-week stocks, stocks hitting their 52-week high versus their 52-week low, and it gets into this ratio range up here, the percentage range, I should say, at 8% more, 8% more hitting their 52-week highs. That's after a long run and a lot of stocks hitting their new peak, and it's going to likely revert back to the norm. We're at about a third of that high range right now. It's about half, 3.3. Okay, now negative at 4. So when it hits here, when we have more stocks hitting their 52-week low than hitting their 52-week high, we're dropping, sort of a negative value, negative ratio aspect, because a lot of stocks have been dropping and hitting their 52-week high. Eventually, hopefully, they're going to start pulling off of that 52-week high, 52-week low, Once they hit them, because very rarely do we see it go into these extremes. Okay, so once we hit to -4, you know, that -4 value of stocks hitting their 52-week low and not many hitting their 52-week high, we get to that negative value where maybe none are hitting their 52-week high and a lot are hitting their 52-week low. That's when it will start to maybe bounce off. Some stocks will start to recover, will be at a bottom, hopefully, and then that will trigger the bullish signal because it has to start going back up now. Okay, so it's bullish when it's -4, because when it's down here, it has to go back, and more stocks have to stop hitting their 52-week low and will start going back to their 52-week highs, hopefully, William. And when we're at a range of 8, we're at the +8 of more stocks hitting their 52-week highs than their lows. Eventually, they're going to have to gravitate back down towards it. How did it work recently? Let's check our distribution, not our distribution, but versus SPX. Let's get our, where do we want to go? Yeah, that's a great one. That's a great one. So you see here that it kind of mirrors it, doesn't it? These two are almost mirrors of one another. So just for 2020, when we were when we were at 8, that was a bearish line, wasn't it? We went above 10, we hit 11, hit 8, hit 11, and that gave us the bear signal. Now this went deep. It was bearish at -4, and then it just kept going, but it was severe here, and it started to come back up. When was our most recent hiccup here? Went down, look, -3, and then we had that little fall. And then we didn't quite get to 8. Here we got to 8 again, and to 10, and then it eased off of that, and we had a little peak there. Let's go back to where that was. Is that an 8? Yep, that's 8. We knew it. That's August. I should have known that was where that was going to be. So let's just highlight, go back to August a little bit. Let's highlight a small portion, go back to August there. There we go. Okay, let me get a little bit more. Oh, no, I'm sorry, way off of August now. Just trying to isolate August completely. There we go. And I said, you know, when it had gone up to near that 8 level, it's just bouncing around and they're tracking in, but it went to a high, we had a little pullback. Got up to a high here, we had a little pullback, okay? And that was through that August range. At the peak here, saw it go down, but it didn't go down a little bit before. It was at 0 line before. In that case, let's isolate that a little bit better. There we go. Yeah, so it kind of tracks the movement one by one, but that's why it's a tight range between 8 and -4 in that case, William. So I hope that answers your question well, to what you wanted to look for the market sentiment. But now we're back into the main screens, and I don't see any other questions that have come through. If you have any last-minute questions, feel free to send them in. A lot of people have been pulling away as we hit the 6 o'clock hour, but I want to remind everyone that today's material are my thoughts and your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct recommendations or direct trading suggestions. We talked about the target positions today. We talked about some married puts on targets. We talked about the different strikes. We did that as an example. I'm not saying go out and buy the 2023 160 strike on target for married put, or am I saying buy the April as well? It came up in our search. The default criteria I would use, and that's where I picked JD from, the new married put I entered yesterday. But again, not direct trading suggestions or recommendations. Options involve risk, may not be suitable for all investors. If you haven't tested out the PowerOptions tools, we saw the search tool today. We saw how to use the custom spread. I should have gone into the volatility skew tool under the signature tools a little bit to show that thing we were talking about with the IV for Satish. I looked quickly at the portfolio, I believe, but you can use these tools at any time. You can start your 14-day free trial if you have not done so. Just name an email address, no credit card information required. You'll have full access to the search, research and analysis, signature tools, portfolio tools, the education that we looked at in the webinars page as well, and much more. So just go to powerop.com, put in your name and email address, start my trial. No credit card or billing information is needed. After that, the monthly subscriptions start at just $45 per month. Most common is the delayed service at $65 per month. We do offer real-time service and an upgrade to the historical service where you can use our backtesting tools for the full data. On the trial, you have access to the backtesting tools, the Smart Search Excel, the search by symbol in a strategy, and this historical option chain, but only be about 3 months of data. Okay. Trial members, subscribers also at any time could take advantage of our free coaching session, essentially a 35 to 45-minute phone conversation with myself or Ernie. And of course, you can upgrade your subscription at any time or cancel. You're no obligation monthly contractual obligation. You can cancel at any time as well. Other free stuff, of course, we showed the archived webinars here. Once more, Satish, under powerop.com/webinars.asp, go to options concepts, scroll down, I think it was to 2014, and check out that webinar on implied volatility, the double-edged sword. Other great webinars are also there in the options strategy section, requested topics, and the tools. You can always check us out on YouTube too. That's where I post every Friday session. Some of the Friday segments don't make it into the webinar archive because I already have a fuller presentation that's already there and available. But yes, they're always on YouTube. You can check that out, or go to the blog or that learning center we looked at today when we looked at the average implied volatilities across the market. Well, if you think of any other questions at any time, of course, just send us an email. You can email me this weekend at support@powerop.com or support@radioactivetrading.com. Some point this weekend for an hour or so, I'll be working on the videos here and other videos that we've looked at as well. You can also call us during market hours at 302-992-7971. Remember, trial members or subscribers schedule a free coaching session at any time. And that, again, is a 35 to 45-minute phone conversation with myself or Ernie. We'll answer any questions that you have and walk you through the tools on the site. Well, ladies and gentlemen, I didn't see any last-minute question comes in. William did mention earlier, I forgot about that Logi has been a nice trade for me. I was analyzing that yesterday when I got into JD. William says, thank you for a great session. Another great session. Enjoy your weekend. Thank you, William. I hope you enjoy your weekend as well. As always, stay safe, social distance, wash your hands, wear your masks as well. And Kip says, thank you. Another great session. Have a wonderful weekend. Thank you, Kip. Same to you. You have a wonderful weekend. I hope you all have a fantastic. And I hope to see you all next week. And I hope to see your comments and your questions next week, as well as any comments or questions on the archive presentations when they're posted. Take care, everyone. Have a fantastic 1st of October weekend. We'll see you soon. Good night.